Hey, everybody, and welcome back to Am I Catching a Falling Knife, the podcast where we break down the latest stock market plunges to see if there's a real opportunity or just more pain ahead. I'm your host, Dave, and today we're tackling a stock that has absolutely plummeted, the trade desk, ticker TTD. In just the last few days, TTD has dropped a staggering 37.04%, making it a prime candidate for our falling knife deep dive. Is this a chance to grab a high-quality company on sale, or is there more bad news lurking around the corner? Let's find out. So, what's driving this sharp decline? The market's primary concern right now revolves around fears of slowing growth and intensifying competition. This really came to a head after TTD's Q2 2025 earnings report and, more specifically, their rather cautious guidance for Q3. Even though they actually beat revenue expectations, that forward-looking caution overshadowed everything. Now, for those unfamiliar with TTD, they're a massive player in real-time programmatic marketing. Think of them as the behind-the-scenes brain for advertisers and agencies, helping them buy and sell digital ad space across pretty much every channel imaginable, from display to connected TV. Their business model is a demand-side platform, or DSP, and their revenue comes from a percentage of the ad spend managed through their platform. Everything they do is through that self-service cloud-based platform, accounting for 100% of their revenue, with the lion's share, 86%, coming from North America. They've always had strong financials, boasting a solid $2.45 billion in latest annual revenue, a healthy $686 million in free cash flow, and remarkably low debt at just $263 million. Plus, their gross margin is a stellar 80.7%. So, with such a seemingly robust financial profile, how did this narrative of slowing growth and competition translate into such a significant hit? Let's break down the mechanics. The market narrative focusing on slowing growth and intensifying competition directly threatens TTD's core and only revenue stream, that self-service cloud-based platform. The cautious Q3 guidance, even after a revenue beat, signaled to the market that management itself anticipates a lower revenue trajectory than previously expected. Our analysis estimates this could lead to about a 3.0% reduction in the upcoming quarter's revenue compared to prior market expectations. Now, here's where it gets interesting. Because the trade desk has an incredibly high gross margin of 80.7%, that 3% reduction in expected revenue doesn't just chip away at the top line, it translates almost directly into a 3% decrease in expected gross profit. But it doesn't stop there. A significant chunk of TTD's operating expenses are relatively fixed in the short term. This means that a smaller revenue base, combined with those fixed costs, creates what we call negative operating leverage. Essentially, a small revenue hit gets magnified down the income statement. Our calculations suggest that this 3% revenue decrease, thanks to those fixed costs, could lead to approximately a 12.1% negative impact on the upcoming quarterly operating profit and, by extension, their earnings. And to be clear, that's an estimate with a confidence interval, meaning the actual impact could range anywhere from a 9 to a 15% hit. It highlights the sensitivity of a high-margin, high-fixed-cost business to even slight revenue slowdowns. So, where does this leave us on valuation? To figure out what this stock is really worth under these new conditions, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow model. Based on assumptions like a projected growth rate of negative 5.3%, yes, negative given the current narrative, a discount rate of 9.5%, and a terminal growth rate of 2.5%, our base case DCF value for TTD comes in at around $8.61 per share. However, when we apply the impact of our narrative case, factoring in that estimated earnings hit, the DCF value drops to approximately $7.32 per share. The second method, usually a simpler PEG-based valuation, isn't quite as useful here. While TTD's current PE is 65.38, the projected earnings per share growth for the next 5 years is actually negative 5.33%. When you have negative growth, the PEG ratio, which normally compares PE to growth, doesn't really give us a meaningful fair value. It's essentially not applicable in this scenario. So, given all this, if you're looking to catch this falling knife, what are some potential entry points? Based on our analysis and considering the updated narrative, some custom buy levels I'd be looking at are around $44, $30, and potentially as low as $15 if the narrative really deteriorates. So, that's our dive into the trade desk. Remember though, this is just my analysis on Am I Catching a Falling Knife? It is not financial advice, and you should always do your own thorough research and consult with a financial professional before making any investment decisions. Markets are complex and individual situations vary greatly. Thanks for tuning in, and I'll catch you next time as we look for another potential falling knife.